Hi, welcome to UOBK Hian CIO Series number 26. Today we are going to talk about Hong Kong market, and thanks to Mun Hon taking your out of time, your busy schedule to join us.
My pleasure.
Yeah.
Thanks, Chief, for the invitation.
Thanks for coming. My name is Wang, CIO of Private Wealth Management for UOBK Hian, and like I said, we are very honored to have Tham Mun Hon, head of our Greater China Research today, to share with us his latest view and strategy for China and Hong Kong in the second half. And it's how can I?
Does it switch? You need to maximize it.
Yeah, no, how to? Flip it. Standard disclaimer. Most of you are already familiar with, so I won't go through it in details. And we always do a recap of our core views and recommendations. And you can find this also in our Wealth Monthly every month on page 2 of the Wealth Monthly, where there's a summary of the core views. We are cautious on global equity for obvious reasons. Tariff is a big deal. Most of the tariffs have been negotiated between the U.S. and other countries, except for China. And based on the results so far, we are looking at an average 20% tariff the U.S. is charging, which is a historical high for the last 100 years. And we're extra cautious on U.S. equity as one of the best performing markets yet to date. Also, not just because of tariff, but also because of high valuation of U.S. stocks. Having said that, we maintain our high conviction in AI sector and stocks. And you can see on the right-hand side our core recommendations for AI revolution. We also like defensive names like Walmart, which we believe are well positioned to weather the tariff environment. In China, we're relatively optimistic, and we've been right on that as well. Hong Kong has outperformed U.S. year to date. A lot of the stocks that deliver more than 50% return. In fact, we're looking at a pretty spectacular rally since the beginning of the year, and the market also seemed largely unaffected by tariffs. But then it begs the question of whether the tariff is really a good thing for China and whether the market is not pricing in that risk. So that's the key topic today that we discussed with Mun Hon. On bond, we continue to like high quality, I would say the mid-term bonds, 5 to 8 year maturity, with a preference for more 5-year bond, the shorter end of that spectrum, mainly because the bond yields are still higher than long-term inflation expectations. And of course, bond also will benefit from the Fed rate cuts. However, as you know, we've been talking a lot about de-dollarization for the past few weeks, and this is definitely has a major impact on bond investing. Our advice is to diversify your bond portfolio, to have a currency diversified bond portfolio as opposed to concentrated just only in US dollar instruments. And for commodity, our only recommendation right now is gold. We've been holding gold in our all ETF portfolio since 2023 and has done very well. And gold is a good hedge against the geopolitical risk, as well as the central bank's possible policy failures. As you know, that including the Fed right now has a lot of difficulties understanding the current macro environment under the tariff. Thus, I think the monetary policy will see a lot of more volatility going forward. Another reason that people want to stay away from central banks and invest in gold. Okay, with that, we will turn to the topic today. Before I turn to Mun Hon and ask him some questions, I want to show you one interesting chart about China's GDP year to date. At the beginning of this year, I predicted that China's economic numbers may beat expectations. And indeed, whether it's first quarter or first half of this year, China's GDP came in okay, despite the tariffs and despite the trade war between the U.S. and China. And if you look at the composition of that GDP growth, about 1/3 of that still came from net exports. So ironically, despite the tariffs, Chinese export remains strong, Chinese manufacturing remains strong, and continue to contribute a big part of the economic growth. Meanwhile, real estate, as you know, continue to suffer and consumption remain weak. So that seems to be the structure for the Chinese economy for some time. But then the question is whether there will be any changes in the second half, given that, look like this export number from China may be subject to risk. So with that, let me turn to Mun Hon. And many of you already know him, probably no introduction needed. He's head of our Greater China Research, have decades of experience in macro research, in sectors research, in strategy. And with that, let me turn to Mun Hon.
Great, thanks, Chi. And thanks for your time to let me run through our strategy for the second half of the year. And yeah, just a quick some feedback. I've been on the road for the past 3 weeks with meeting investors in Asia. I think generally feedback has been quite positive. Investors are looking at actually adding positions in China. It's quite a good change from about a year ago when investors were still asking about whether they should be in China at all. But you can see that for the this round of meeting I had, investors are basically at the very least, market weighted on China and actually looking to add more positions. So that's quite encouraging for someone who's been only covering China. I think the interest is actually quite encouraging. Yeah. But what's our view for the second half? Like Chi was saying, there are quite a few risk factors out there. But I think for me, I mean, be frank, we were quite cautious when we started the year. Yeah. The last time I was on this series with talking to you about our outlook for the year, I was cautious. I was afraid about we
talked about U.S. election.
Yeah, growth slowdown, about the impact of the tariff. But what has changed? If you look at the slides that I have here, I think the key one is really about the growth outlook. If you look at the top left-hand chart, you can see that look at the near-term growth indicators and the PMIs. It's true that things are slowing, but it's actually not as bad as what we feared. There's no risk of a near-term recession globally. And I think what is quite important for equities is that if you look at the lower chart, the total assets of the major central banks actually bottomed about 3 months ago. So you have decent growth, you have improving liquidity. That's a very good mix for equities. So the near-term challenge is really about how China will deal with the weakening growth. Like Chi talked about the first half of the year, things seems pretty strong. Exports are doing well, but as I explained to investors, in other meetings, I think part of that is really due to the fact that the U.S. businesses will bring forward the demand because they want to front run the higher tariff. They want to avoid the tariff.
Yes.
So as a result, second half growth is going to be weaker in terms of net exports demand, right? And then for China, you can see in the top left-hand chart, outside of the sectors that are supported by government subsidies, the retail sales is actually pretty weak. So it does tell you that, this Politburo meeting that we're having now, that the government should focus more on domestic consumption. And it's actually quite encouraging. We saw news yesterday that they are going to shift more money into, let's say, encouraging more childbirth, encouraging to improve the fertility rate, giving more money to families with children. So that's a good change because previously China just focused on supply side. Right now it's more demand side, and I think that's something that should cheer the market as we look to the medium term.
Yeah, it was like 3,000 RMB a year, right?
3,006 per child.
Oh, per child for 3 years.
Yes.
For 3 years.
Yeah, okay. So that's actually a pretty good change. Something which I told investors that you have been looking at supply side all the time, looking at excess capacity issues, but now what we need is really more support on the demand side.
And the other thing they continue to do is the trading program.
The trading. Yes, and
to stimulate the consumption.
Correct. That's quite important, I think. And the other thing is, of course, like Chi said, property side is still quite weak. You can see that the changes in the prices have again, month on month, it's been coming off. The main reason is really inventory is quite huge. So I think in this July meeting, we do hope that they will announce more measures with the destocking of the inventory. Still running about 23 months of sales, still quite high.
Yes.
Yeah. Okay, yeah. Anything you want to go on?
Yeah, well, let me just jump in for a second, because today is also an interesting day, because I think the Stockholm negotiation ended, and basically I look at the news release, it's kind of a non-event. I don't see anything incrementally new there. Do you have any prediction of how this will play out eventually? Could look like this is the only remaining big negotiation that the US hasn't
Yes.
closed, and it's taking forever to close.
I think, from what we've seen so far, China is really driving a hard bargain. I think they know that they have to set up for their own economic priorities. They have to look after the Chinese growth. And I think being able to export when currently you have some excess capacity issue is actually quite crucial for China. So I think it's going to be very tough for the US to try to make China agree to relatively unfair agreements like the deals that they have done with the EU or with other countries. So our base case is that Trump might just end up with something with 55 or 50% as a base case, because we take the cue on what they did with Vietnam. They did 40% of the transshipment from Vietnam. So if that's the base case for low value added products and high value industrial products, it's going to be probably closer to 60, like you talked about before. So a blended rate of 50. So is that a issue for China? Yeah, definitely. If you look at most industries in China, they have gross margins about 30%, net margins in the teens. So I do expect that once they have an agreement on a tariff, the Chinese government will come up with more support policies for targeted policies for specific industries. There will be no shock and awe, but very targeted help for the affected industries. Yes.
And so you're based on what you said earlier, you're expecting second half for this tariff to impact to kick in, because you said earlier that the strong exports in the first half is really the pulling effect as China and other countries want to front run the new tariffs. So are you more worried about second half this year? The export and also Chinese.
Yes, definitely growth would be slower than the first half, but I think that the government does have the means to support and they stand ready to support the economy. So I'm not too worried about the growth. But on the upside, once we have more certainty on what the tariffs are, I think it's actually positive for the market, because now we can move on to the next phase, focus on what can potentially drive growth or support growth. Instead of like waiting on what's going to be the tariff and then companies stop investing, production sort of slow down, just to know what the tariff is.
Remove the overhang, but unfortunately the overhang is still here.
Yes, it will be. It's something that China has to deal with.
Yes.
Right, but then again, China is not going to be alone in this, right? All other countries have higher tariffs, exporting to the US.
Got it.
Yeah.
You talk about also you mentioned interesting observation. You saying that you see when you are on the road of marketing, you're seeing renewed interest in China among investors. And this is consistent, by the way, with our last CIO series last week, a Chinese one with independent research house Horizon. He said that even though southbound into Hong Kong is being strong, but they also are seeing some evidence of global institutional investors coming back to Hong Kong. Do you agree?
Yeah, definitely. I think that the other one that which I was showing to investors, which they do agree on, is that if you look at this scatter plot chart here, you just basically the current PE versus expected EPS growth. China, which is CN here, despite the outperformance in the first half, it's like still trading at pretty attractive, valuations compared to the regional markets. Of course, you can argue like, is China really going to do 12% EPS growth? Well, probably not. Well, you dial that back about maybe 8%, because nominal GDP growth is about 4 or 5. Better corporates get listed, you do about 8% EPS growth. Then your PE is about 12 times. It's still, quite attractive. So that's why I think that, when people look at on a regional basis, I think China still looks good. Yeah.
That's another reason we prefer China over the US this year. As I mentioned earlier, that if you look in the US, the opposite, right? So US, the valuation at a pretty high level versus China is only US is I think is 23 times for S&P 500. While China, even though the market has rallied,
it's about 12.
It is still about 12 times.
Yes,
which is below the average, slightly below the average.
Over the years, historical average is about about 11.8, just slightly above now. Yes, but again, it depends on what the EPS will do going forward. Yeah, This at this point, yes.
And there's a structural change in the economy. The index composition
yes
has changed
definitely.
With more new economy stocks, higher margin stocks. So just to summarize, second half we may see some risks because export may slow inevitably, but China has a toolbox of policies they can. We talk about the consumption subsidy, the trading program, the child subsidies, right? Any other policy that we can expect in the second half?
I don't expect any bold announcements currently because if you look at the bond quotas that they have for the year, it's about 6 trillion. Up to end April, early May, they've done 40%. I said issue 40% of the quota. So they have another 60% more to go. So they don't need to have a new quota at this point. Maybe come November, December, you might hear of new quota. And then again, the other catalyst is probably the next 5-year plan, right? They talk about that, and that could provide more catalyst for the market. So I think that's what we can look forward to. And on the monetary side, also don't look for too much. You will remain accommodative, but if you look at the numbers, the room for triple R cut, we only have one more before we hit 6%, and then rate cut probably another one more because the deposit rate is really quite close to zero. So monetary, they're not going to do incrementally. They can't do a lot more. So the focus will be on fiscal.
And including the recently announced the dam, right? The electricity for electricity generation. What do you think of? Did that surprise you? The amount seems pretty big, but my understanding is 1 trillion, but over 3 years.
It's a multi-year project.
Multi-year, sorry.
And
then 10-year project.
Thinking about all the demand for electricity in terms of building out EV or your AI network and everything. No, this is just planning ahead. So should not surprise people that China is moving in that direction.
And it's a big infrastructure spending story. Okay, so assuming that's the base case for the macro picture, what do you suggest is the investment strategy for the second half?
For the second half,
2026. I mean, also we are towards the
Yes,
it's not too early to think about that as well.
Well, I think it's still probably at this point, my base case is still a trading market, right? Because I talk about how I expect the market to. Basically, my pitch is that I think the second half, in the second half, there's still more upside to the market. We pegged the target to about 13.8 times 12.4 PE. If you look at the next chart, this is like one standard deviation above mean. We are about 12 times recently, so there's still some upside left in this re-rating. While I'm looking at only PE re-rating, like I mentioned, growth itself is not going to pick up in a very big way. So what's changed is really sentiment, right? So when you get the tariff uncertainty out of the way, what you get is that, this is also, it didn't have the other chart that I have was that the risk premium is still actually about 2 standard deviation above mean. That will compress, and that will drive the next level of re-rating. So I would think that given that it's mostly sentiment driven, PE driven, it could just be a short-term trade. So what could be providing further legs to this rally? I think we could run to September, and then by September, we have to see whether the Fed starts the rate cut cycle. If they do, I think there'll be more tailwind for EM assets, including Chinese equities. If not, we might have to consider profit taking. So I don't know. I mean, I can't see so far, but at least these are the various things that I want to watch out for in the coming weeks or months ahead.
That's a good point. Most people look at Hong Kong without considering the Fed, but the Fed is actually a really big deal here.
It is. Global liquidity.
Global liquidity. And I remember in September last year when we had the big stimulus is also right after the Fed cut rates. And that's why China
has the window to do it,
has room to cut as well. So that's definitely these two changes are related. Okay. So any particular sectors or stocks you preferred?
I think if we look at what's been happening for the last couple of weeks, is that investors have been. If you look at this chart here on the lower right, they've been rotating into the defensives, into healthcare, into consumer staples, into financials. You saw the banks actually did quite well. People want to hide in U play, but we think that as we approach the conclusion of all these trade talks, is about, and also the underperformance of tech over the last two months, I would say. it's a good time to rotate back into the high beta names as you know, as I mentioned, as uncertainty goes away. So I focus on the big tech names on the growth angle like AI or robotics exposure. Look at some selected EV names because EV is going through a tough times now. It's more mature in the cycle. So generally, big cap, higher beta is what we like. So if you look at the list here of stocks that we do recommend. I think, of course, within that list, some are high conviction, some are lower, but the key ones that we like for AI theme, AI related is Tencent. We like Baba. I mean, it's true that if you really want to drill down to the numbers, that the exposure to AI related earnings is quite low. I mean, I checked the analysts for now, our projection, from the numbers that we see, contribution to bottom line from AI related businesses is only about 5%. But then again, we always buy for the future, the outlook, all right? So this is where the incremental growth is. So I want to be positioned in Tencent and Baba. And for AI related hardware side, FII, Foxconn Industrial Internet is what we like. This is highly tied to the NVIDIA cycle. As you saw, the bottleneck on the GB200 GPU has been resolved. So the near-term delivery is going to be quite strong, and this is what we like. So that's AI.
Does the US lifting the H20 restriction also help Foxconn?
Yes, it will help.
It will help.
Yeah, it will
to a
help.
certain extent, right?
Yes. And then the other one, of course, I mentioned robotics. Robotics, of course, if you just look at industrial automation, forget about it. It's not going to be strong, right? Because there's so much excess capacity. You know, industrial demand is not really going to be that strong. But it's really the thematic play on humanoid robotics. And within that part, I think what we want to look at least for what we cover, are the component providers. So we like Topu, Nippo Topu, the fifth name from the top. And then two names down, we like Zhejiang Shuanghan Driveline. They provide the reducers. So I think these are two names that will continue to do well as investors continue to be quite interested in the development of humanoid robotics. Yeah, so that's on the growth angle. So I did mention about EVs that we're going to be quite selective, right? So
I'm sure everyone is interested in right now. We will leave some room for people to ask, some time to ask questions on that. But yeah, let's talk about EV industry. What's going on in China right now?
I think again is back to the same questions about how the macro policies have been run. If you recall, you know, they shifted the loans from real estate to industrials, right? To green loans as well. And then you have this excess capacity in autos and in solar panels. So, you know, now that timely that Xi Jinping talks about end to involution, he wants supply side reform, and now he shifted some more money into, like we just talked about, into child care subsidy. So that's actually quite a good move from the supply side to demand side. But EVs itself is a victim of its own success because of all the subsidies. A lot of companies got in, a lot of capacity is built, like some companies actually running at 40% utilization rate. They're not going to survive. So that's why we have this deep, very intense price competition. So we rather not have any names of the EV manufacturers now. The only name we like now is Kato, the battery provider, the fourth name from the bottom. So, and I think that, yes, people are actually concerned that would they also face some pressure as well if every of their customers is facing pricing pressure. But then again, I think that for them, one of the positives in the near term is that they've just launched the sodium-ion battery into mass production. That's supposed to be the one that's more higher on the safety standard, more fire retardant. So I think they should be able to manage their margins much better with this new product.
The CNT also has Hong Kong shares.
Yes.
Okay, so here is the Asian.
Oh, but this is just
okay.
Yeah.
I buy that story. So right now for EV, you don't think it's a good time to really pick up the brand, the bottom fisher to. Right, so Kato is really a supplier chain.
Well, short term, our pick is actually Geely, right? Because we think that Ken thinks that the model launches this year is very meaningful for the new models, and I think the sales have picked up quite strongly on a year-to-year comparison. But if you look at it longer term, I think we still like BYD as well when they get over this issue because at the end of the day, they have the lowest cost. I think they're better able to survive this competition.
They have scale.
So
they also have technology.
Correct.
Yeah, they make
on the battery side as well. So I think you can look towards smaller fishing on that name further down the road, but now it's a bit too soon, I think.
Yeah. And then Xiaomi, you're not positioned this as an EV play?
Yes, currently yes, because from our the feedback from my analysts is that they will turn profitable on the EV side, at least break even in second half this year instead of the earlier guidance of 2027.
Wow.
Yeah, so this is why we had this name at the end of last year. In fact, we're looking at taking profit in the first half, but now we kept it on because the momentum is actually very strong in their business. So, and of course, the other thing is that I think further down the road, if you want to be a longer term shareholder of this name, is that potentially you can still see them introducing more AI-enabled products, right? That's something I think is probably going to be a low-hanging fruit for Xiaomi, given that they're a very strong IoT business.
Yes,
Yeah.
they're catching up definitely.
Yeah.
And then, so quickly to recap on the EV industry, you expect some kind of rationalization,
Definitely.
or what do you call it, like basically a battle between the
Yes.
brands.
Yes.
But clearly that BYD will be winner.
I don't think so, given the scale they have achieved, like you say, the technology. But then it's not going to be very easy this time because a lot of the names, they have provincial governments as their backers, or their investors as well.
Yeah.
So for them to give out on the business, and that might potentially affect the GDP from the province, employment there. So I don't know how the government's going to handle it, but it's going to be a tough battle on this front.
Tough battle. It takes some time to play
Yeah.
out. And then you mentioned GD.
Yes,
They're
it's
doing well, and Xiaomi definitely.
Yeah.
It's not just in EVs, I guess.
Yeah.
They have a complete ecosystem of things. And then the CATL makes sense because I think the logic for CATL as a battery supplier is really regardless of who wins,
yeah,
they were able to sell more
correct. Volume.
power batteries.
Yeah,
right?
and the margins is protected by the new product they're launching. Yeah.
Have they been gaining share globally?
They're already the biggest.
Is there?
I don't know have the latest. I don't have the latest figure. Yeah.
My worry is, will there be a natural cap on their market share because they're so dominant and their customers will kind of afraid of them and try to diversify the sourcing, That often happens.
So
these dominant players.
Yeah, what's crucial for them is really to keep the lead on technology, and I think they've proven that with the new product launch, the sodium-ion battery. I think that's what's encouraging.
Great.
Yeah.
And one thing we didn't touch upon is consumption. Of course, AI may have a consumption angle. We talk about AI, we talk about EV. Any interesting consumption?
Yeah, consumption is tough, right? Because we also tried to introduce some names we thought might benefit from improvement mass market consumption, but CRBI didn't do well recently after the results, so it's tough. But I think where we have more conviction on is really consumer services. Of course, you talk about like PopMart, all they're doing well recently. But if you look at it from a macro perspective, if you look at the numbers, really, you can see that actually the pricing power amongst providers of consumer services are actually doing better, like on the travel side. And what we have here, a new name on that coverage is Tencent Music. And again, when we talk about shifting consumption pattern, you can also see that people are more open to paying for music these days. So when Tencent Music launched the program at the end of last year to try to encourage people to subscribe to a package, like now, pay 20-25 RMB a month, you get a VIP package, you get good quality music, and people are signing up. So this is what we are looking at when we recommend this name, is and the penetration is actually still low. So there's going to be quite good growth potential for Tencent Music on this front. And they actually have signed up much better music labels as in provision of the library of music compared to what Net is providing. So we are actually quite positive on this name.
Interesting. I would have thought that people, given the macro environment, people would not be willing to pay. And
but it's small ticket. It's like $20-25 a month. Yeah.
And so there might be some structural changes here within Chinese consumption that are driving, right?
Yes, definitely.
Towards these paid subscription services.
Yes.
Is that the number one in China in terms of music?
No, I think because under Tencent that two or three apps. If you add them together, I think they're the biggest. If I'm not wrong, From my memory, I think I remember they're the biggest. If you add them together.
I heard about this name from other people too. I think it's interesting to dig further into. And what kind of growth we can expect from a company like Tencent Music?
We are looking at mid-teens,
which is already quite good.
Yes. The retail sales itself is selling about 5% now, right?
Yeah, I know.
Yeah.
And then when it comes to internet, we always think there's no very little regulatory risk here, right? It's not like gaming, which
well, they did. I mean, a few years ago, I think they did when NetEase launched a legal challenge to Tencent having a monopolistic rights over the music that they sign up. But I think that's pretty much resolved. So I don't think near term there's anything to worry about. Yeah.
Okay. I also see you have trip.com there.
Yes, about trip.com, I would say that is in the medium term we still think that Chinese want to travel experiential kind of consumption. And incremental growth is definitely stronger on overseas travel. But I would say that the feedback from investors, they're actually quite concerned about the near-term competition. Because quite a few other players are going into the space as well. So I think while they're positive on it as a theme, it seems like they might not want to jump on to this name on the bandwagon again so soon. They want to wait it out. Yeah.
Because I know TikTok is getting to the business, Meituan is getting to the business.
Yes.
I do want to make a point that, I'm a user of trip.com. I also use many of the consumer services in China. But one thing is that only for trip.com, I use my real identity.
All right.
Yeah, because they have to use a name to book tickets for you.
Yes.
Even my passport number has to be exactly correct. Otherwise, you have a mismatch and your ticket could be fortified, or you cannot board the plane, or your name spelling wrong. So I think they do have some advantage there that having true identity of the users versus TikTok. A lot of people just putting fake names and addresses, that type of things. And then I think, as far as I know, I don't think TikTok and Meituan are getting to the travel tickets business yet, right? They're just competing with hotels and package tours and
I think so. Yeah.
And maybe dining, those package.
Dining, definitely.
Yeah. So I think this their strong position, Trip.com's strong position in booking travel tickets, that would be plane tickets, boat tickets, train tickets. I think it's still a big advantage to them because from there they can really drive other businesses.
Correct. We actually still like this name on the medium term. Near term, they do face some, I think.
And I've heard there's also an AI story behind Trip.com. It's the company hasn't announced it yet. Definitely, I think based on the data they own and based on the ecosystem they operate, I think there's a lot of interesting things they can build.
I see.
In terms of AI.
Interesting.
Yeah. And then any other consumption names worth mentioning?
No, not really. In fact, do you want to focus on pure consumer names, because I think that the whole structure has changed. The traditional names are not really that exciting at this point.
And then new consumption names are too expensive, right?
Yeah, but of course the tech names are actually consumption as well, right?
Those are cheap.
Yeah. So because
they're
classified as a tech name, but actually it's pretty much consumption. Yeah.
No, when I'm talking about new consumption, if you put something like Palmar, do you think that's overvalued?
Yeah, I think that's a good run. I think it's good to focus on something with better risk reward at this point.
Yeah.
Because I think if you talk about funds flow, about how who's positioned in this market, I think so far a lot of it's southbound flow, regional funds, but a lot of global funds are only starting to come, looking to come back in. And I think if they do come, the first pick is obviously the index, the big cap. And I think that's where you want to be.
Yes.
Yeah.
And the big cap do offer pretty attractive risk return right now, especially as you mentioned, whether it's since the tariff or year to date, tech actually underperformed.
Yeah.
Right.
Yes.
This year the market's done well, but the stocks that done the best are not necessarily the big tech names.
True.
So again, I want to stay on the topic of Palmar. I think a lot of investors are interested. Do you think their business model is sustainable? Because a lot of people question, say, oh, your IP is not really your own. And then what you essentially do is sourcing IP from external parties. And essentially you are a one-shot wonder, right? Most of the, you look at the successful products, and just a few, just a couple, in fact. Most of the other products are not selling that well.
Yeah, definitely there will be that. That's why I think I'm not too keen to buy this name now, right? Given the valuations, because there will be a time when the interest will cool off and people start questioning whether this business model is sustainable, like you just mentioned. But so it's really up to them to prove that they have a strong pipeline of IPs. I think that then when the sustainable re-rating will come in. So that's why I tend to want to catch it now.
where is the kind of the next pop mark? Maybe not the stock. What trends you're seeing within Chinese consumption could be interesting? Like,
I would think that the next one is really on this AI application,
Yeah.
AI enabled products.
Yeah.
So
Especially services, right?
yeah, I think Tencent and Baba is interesting because they already have the ecosystem, they have the apps,
Yes,
so it's a lot easier for them to push through the new upgraded products with AI capability, which they're really doing. Like you saw the World AI conference, it just
Yeah,
it-
this
the
weekend.
new, correct. You've seen all the new models. I mean, AI models that they're going to be launching. So, of course, we did mention just now about Xiaomi, right? On the
Yeah.
consumer side, I think that's what you can look forward to. So I still think that the next phase of interesting products and services coming out is going to be AI driven. Yeah.
And it could lead to a suite of new consumers products.
Yeah, and all these names are actually on the Hong Kong, listed on the Hong Kong market. So that's why I think one of the key questions I had on this roadshow, on the recent roadshows has been like, should we not look at Asia as it has been lagging? But I say, but look at who is going to be the early adopters of AI and benefiting from this AI adoption, right? It's all on Hong Kong. And the other point I did raise to investors is that if you look at the A share, they're still trading a premium to H shares, right? About 20%. And you can see historically, because A and H could trade on par. So we do have room for upside.
Yes.
Yeah.
And then I shared this morning, it is, this cycle is interesting that the market is up, but Asia actually underperformed.
Yeah.
So you're right, the market is really trying to tell us something, that the A-share names, generally speaking, we don't have a lot of the AI leaders or beneficiaries.
I think the only short-term catalyst for the Asia could be if Xi talks about the end evolution and then part of the supply side reform involve the old SOE, the traditional SOEs, which have representation on the Asia market, and then the market could re-rate on that one. But if you look further, when interest goes back to AI again about the future, I think Hong Kong would continue to be the focus.
And Hong Kong, based on the pipeline, we could have more robotics and AI names coming to this market, and that's part of the reason that drive this year's rally. Okay, before we go to Q&A, any key points we missed?
No, I think we're good. We pretty much covered the key messages.
And any other questions that you get from your investors on your trip that worth mentioning?
Yeah, I think there were some questions about banks, whether it should still be in the financials, and what's the upside left. Like, we did tell them that, well, my analyst is making a good point that if you look at the H shares, the Hong Kong listed banks, they already traded quite close to the A share valuation.
Yes.
So the upside is quite limited. It's good to rotate. And we're recommending insurance names instead of the banks. So if you recall our stock picks first half of the year, we had China Merchants Bank, and now this time around we have an insurance name to recommend to investors. I think if you want a proxy to what the stock market could do, there are a lot of questions about Hong Kong Exchange, but if you look at the valuation fundamentally, right, I think the improvement in the ADT is already reflected, the trading volume is reflected in the share price. Yes, there's going to be a lot of IPOs, but IPO fees is not a big part of the earnings. The big driver is really the trading volume. And that's in there. Of course, the more IPO, the higher the ADT going forward. But at least in the foreseeable future, I think we have priced in the higher trading volume. So what are the proxies for better market insurance? Will be a good proxy for a better market outlook. So a lot of investors like to look at Ping An. I think we like that name as well, but we did pick PICC because purely it's more defensive. The valuations are lower, but it's fine if you want to pick a life insurer. Yeah.
Like you said, they benefit from the improvement in sentiment, right?
Yeah, because of the investments, they do invest in the equity market. So a better equity market is good for them as well. Yeah.
With the low rates in China, will probably be good for them. Okay, so let's move on to Q&A. If you have any questions, please enter them in the Q&A window. There should be a Q&A button in your user interface, and please use that to enter the question, and we will answer them in the order that they come in. So there's one request to comment on Kuaishou.
Yeah.
Any thoughts, any views? If not, we can move on.
No, I think for us, we are quite, quite sure Meituan, PDD, all this, we're actually not really recommending them now because of the competition.
Okay.
Yeah, but quite sure. I think what you want to track in short term is really about they also have the AI on the video side or the video generation, so that might be a good catalyst for short term play. But if you're looking for a longer term holding, we don't really recommend quite sure at this point. Short term play on new AI engine or video,
Yes.
content creation. If the how do I say, if the market is very excited over the concept in the near term, it could be a very high beta play for you. For trading, yes, but for longer term holdings, not really. Yeah.
What's the issue? What's the issue? Longer term issue?
Competition.
Competition.
Yeah.
Especially from big tech, right?
Yes, correct.
Tencent video.
Yeah.
TikTok is a monster.
Yeah. So short term high beta play, yes.
Okay. Well, here are some requests on what are your views on the forward performance of, well, first of the Hansen Tech, and there are two other, I don't know these names that well. I never heard of. There's ETF or. Well, maybe just stay with Hansen Tech. Any thoughts on that?
Actually, I've been, on this roadshow, I've been telling investors to rotate back into
Technology.
tech stocks. If you look at the valuations and forward valuations of Hang Seng Tech, is one standard deviation below mean, is still quite attractive.
Yes.
Then, of course, the counter argument that some investors or pushback was like, come on, there's a lot of competition. Like we talk about competition in food delivery, competition in e-commerce. That's why it's cheap for a reason.
Yeah.
But then again, there's competition everywhere in EVs.
Oh yeah, much
in
worse.
F&B.
Yes.
Yeah. So then again, you shouldn't hold the competition against them. So then you look at who's going to deliver better, stronger growth. It's still going to be the tech names.
Yes.
So that's why I think tech will outperform in the second half.
I think you're right. I think there's an element of investor want to shun away from these names to see a bit of a chaos, right?
Yeah.
So right now, if you look at JD, Meituan, Alibaba, I mean, they're all getting to each other's businesses.
Yes.
And it's chaotic and it's a lot of confusion, even.
Yes.
A lot of debate of who's going to win eventually. But like Mun Hon said, comparing that to the competition, the other
elsewhere
traditional industrial,
it's everywhere.
Even electric vehicles, it's much worse.
Yeah,
it's much worse. So I think China big tech is still a pretty unique space. Well, it's not monopoly, but it's really oligopoly. Maybe there's eventually, if you're not sure who's going to win, just buy them all. It's only
buy the ETF.
No, just only 3-4 stocks anyway. It's not like you have EV. How many EV brands? We have over 100 EV brands.
There are a lot. If you go to China, it's a lot.
Yeah, so that you cannot possibly buy them all. But big tech, I think it's doable.
Yeah.
Okay, so are you familiar with these two? If not, we can move on.
No.
Okay.
Yeah.
JD Baba and Meituan are recently calling by regulators. What do you make of that meeting, and what are your thoughts on JD and Meituan?
Well, I'll just offer my 2 cents worth on that. I think definitely, they will have the pressure to stop the competition in the short term. They have to show that they told the line, but the discounts, the discounting, and all the subsidies will come in another form sometime down the road. Because I think for the big tech, let's say look about JD, they already have the infrastructure already put in place. They already invested the money. Yeah, it'll be quite silly of them not to continue to try to make further inroads into this new market segment for them. So you will come back. There'll be more competition. So unlikely to go away so quickly. That's also the reason why within the 3 e-commerce names or food delivery, we didn't recommend food delivery for e-commerce. Only look at Baba because more on the AI angle rather than the e-commerce. In fact, compared to Tencent, it's actually not doing so well.
No,
right? So between that and Tencent is my pick. Yeah. Yeah,
the e-commerce. When you talk about e-commerce, really, it's tied to the overall consumption in China. And if you, like you said, if you look at the overall consumption in China, it's a single-digit growth story. Yeah. Online consumption, well, maybe double-digit, but it's not. It's low double digits. I mean, it's maybe 8 to 10%. Yeah. It's not an exciting story anymore. It's true. But within the consumption, there are some exciting story, but it's not Alibaba. It's not. It's a pretty mature market. Would you say in China, the e-commerce?
Definitely.
So the competition will be there. So I guess this meeting was called to ask these company to take a break up on the competition, right? To don't
Yes.
sue each other, I guess.
Yes.
The government doesn't like competition.
Yeah.
Okay, for Trip.com seems to hit a resistance around the 500 mark. What are your thoughts and what would be stimulate the
next round, the next
next
level.
one to 600? Fundamentally.
Well, definitely has to come from the growth. I think definitely a big jump in overseas travel. I don't know how things will shape up globally, but hopefully with the agreement on tariff, then we're back to opening up the economies. And I think services is still going to be a big part of global transaction. Hopefully that, if in fact, I do have my own sense is that I think Trump might actually come out with a tariff that's lower because at the end of the day, he still has to consider the impact of the inflationary impact for the US consumers.
Sure.
So if that comes in at lower end, the sentiment coming out from the negotiations is positive, I think there could be further opening up. I think travel itself is one big thing, right, for China. And so I think that could be the next kicker, but we have to wait. But if you look at just the calendar on the short term, then the next golden week, all right, we'll see what the numbers are.
And the summer holidays now.
Yeah, but you want to talk about a structural factor, a catalyst, then that has to be, further improvement in geopolitical situation. If not, that's going to be very, very difficult. Yeah.
Yes, the geopolitical risk is a big deal for these travel companies. And the next checkpoint, as Mun Hon said, we have the October Golden Week.
Yeah.
We also have the summer holidays now. And then don't forget all Hong Kong listed companies will be reporting interim results next month, right?
Yeah.
Somewhere around
in August. Yeah.
In August. So this also will be a checkpoint.
Starting next week.
Starting next week. So for Trip.com, as Mun Hon mentioned, I think competition is always an issue. I'm actually not too worried about the competition, but the market is always thinking that, there'll be a next Trip.com out of TikTok or out of Meituan to dethrone its market leadership. I don't think that's going to happen. Like I said, its core, it is still in the travel ticketing business, that once you have the ticketing information, it allows you to cross-sell or upsell on many other products, travel-related products, whether it's hotels or package tours. So I think they're still very well positioned. And the other thing is, even though we're being bullish on the domestic tourism, inevitably domestic tourism is slowing down because the last 2 years have been exceptionally strong. Just think about the reopening in 2023, right?
Yeah,
and then you have we call it revenge travel in 2024, and now we are 2025. That effect is obviously going away. So we're not the domestic travel is no longer benefiting from the reopening story. It's normalizing and it's facing a high base from 2024. But however, having said that, over the long term, we're still positive on China's tourism growth. 2025 may be just an adjustment year. And just some anecdotal evidence. I was in Shanghai last week, and then have a noticeable difference between the in terms of inbound.
I see.
Tourism, inbound tourism. People from Europe, from India, from Southeast Asia, from Russia. I see a lot more foreign tourists into China these days.
Okay.
And that's also policy driven, and obviously Trip.com is a key beneficiary of that. And what are your thoughts on HSBC? Yeah. We continue like HSBC. I think the company will continue to benefit from an attractive dividend yield. I think they're still paying around 5% after adjusting for the special dividend, and the optimization plan that the new management has been executing, including cost cutting, structural optimization, share buyback, and making streamlining businesses and making their wealth management a global business. The wealth management really is the crown jewel of HSBC, and you can see the companies focusing a lot of energy on forming a global wealth management department to capture the growth there. So we're positive, and then there will be a valuation re-rating because HSBC typically people associate that with China, with Hong Kong, and Hong Kong, as you know, there's commercial real estate risk. There's this new world thing that's going on that's just not good for sentiment. But at the end of the day, HSBC is a very well diversified company. Okay, their loan portfolio, 40% is from Hong Kong, China, but another 30% is from UK, in fact. And the rest is from Southeast Asia and Asia, those places. So, in fact, HSBC is not a Chinese bank. It's not a Hong Kong bank. It's a global bank. So as more people realize they have a diversified business and diversified loan portfolio and not strictly tied to the Hong Kong real estate risk, I think the valuation re-rating will continue. So roughly speaking, the stock is currently trading about 1.1 times price to book versus JP Morgan at 2.5 times. So conservatively speaking, if HSBC go to 1.5 times price to book. So we're not expecting HSBC to be at JP Morgan, but just to be conservative, let's say 1.5, 1.6 times price to book in the next 5 years. That's about 10% capital appreciation every year, plus 5% dividend yield. So that's kind of the risk return you can expect. Okay, again, if you have any questions, please use the Q&A window to enter your question, and we will answer them in the order that come in. Any other questions, please use either the chat window. We prefer the Q&A window to enter them. I missed a few between. This one, right? Between the banks and the tech sector,
I prefer tech.
Yeah,
because I did mention earlier that we did have banks as our recommendation for the first half. We had China Merchants Bank.
Yeah.
Because at the time I saw that the valuations are really attractive, 0.3 times price to book.
Yeah.
It's a no-brainer with the kind of yield they're offering.
Yeah.
But now that the valuations have caught up, and I know it's true that they are at the end of the net interest margin compression cycle. People might want to turn positive, but there's a reason why we don't think there's further upside for the price to book valuation, because at the end of the day, there's still concerns about the quality of the assets, right? And also, I think the low interest rate environment will stay for quite some time. The banks really still have to do a lot of heavy lifting.
Yeah.
And so, given the outperformance they had in the first half, I would rather have tech for the second half.
Yeah, definitely more upside in tech.
Yeah.
And probably the banks, I think, the other issue with the banks is the loan growth has been anemic in China. So back to what I said earlier, there's a way to look at Chinese GDP, right? The three horses of the Chinese economy: consumption, investment, and exports. We just mentioned that exports is the only bright spot. Consumption is not that strong, and investment. If you look at investment, the private sector investment is still very weak, including mortgages.
Yeah.
Right, because the real estate continue to decline. So banks will definitely suffer from slower than expected loan growth in China. But having said that, I think almost all of them has done, the big banks have done the refinancing, except for ICBC, I believe.
Yeah.
So I think that removes some overhang for the next 2-3 years, given that they have just recapitalized. I think the banks are relatively safe because the tier 1 ratio is all well within the range and seem pretty healthy to me. It's just that like Mun Hon said, how much upside at this level? What is the average price to book now?
Well, getting close to 0.6.
0.6 for the H share.
Yeah.
So 0.6. Well, maybe I don't think we'll ever go to 1 times that the Chinese banks will.
We haven't seen 1 times for a long
time. Yeah, I would say if it goes to 0.6 to 0.8, I don't know for how long.
Yeah.
Versus technology, you could get easily 30% return in 6 months.
Yeah.
Right.
Yeah.
Which is not that unthinkable. comment on Xiaopeng and Hua Hong. Oh, I'm
Yeah,
not sure.
Xiaopeng, I think they did quite well in the first half in terms of the new model launches and delivery.
Yeah.
But again, now the sentiment on the EV news are no good. Is it good to bottom fish now? Well, you do have to consider that I think Xiaopeng still need to raise cash going forward.
Yeah.
So if I were to bottom fish a name now after the EV names corrected due to all these concerns, I'd rather pick BYD, to be honest. Like you mentioned earlier,
a safer
price scale,
Yeah.
and definitely a much lower cost of production and technology. So, yeah, I think that's what we'll do.
What about the speculation that people say BYD is the next Evergrande? Is there any ground to that?
Well, we don't know because in a way, a lot of this indebtedness could be hidden at the parent co, which we will have we don't know, at least not on the list of vehicle.
I see.
Yeah.
Hua Hong, any view?
No, we don't.
Okay.
We don't, yeah.
Noratech, any view? Noratech, do we cover?
No, we don't.
We don't cover Noratech. But please note in our China biweekly outlook, which is published recently, I think today, this morning, Johnny talked about Nora. Now, these names we don't have full coverage, but because Johnny covers semiconductors, SMIC, and Xiaomi, I think this company is benefiting from the so-called export substitution in semiconductor manufacturing equipment, and then it seems that SMIC has made some more breakthroughs. Using the domestic equipment, so that's positive. I don't know about the valuation of these stocks. These Chinese semiconductor stocks are usually very expensive. That's why when you buy it, you will experience a lot of volatility. We cannot advise on the timing of it. BYD Electronics, do we cover BYD?
Yes, we do. But I haven't looked at it recently. But the last time I had a conversation with Johnny on this name is that he's just telling me that the short-term growth outlook is not so strong.
I see.
And valuation is a little stretched. So that's why we didn't revisit the name after that. So I think I haven't heard of anything that's changed the outlook so far. Yeah. So not something that we'll advise at this point.
Okay.
Yeah.
Talk about insurance company, 2628 versus Ping An. How is it? He said moving up so much compared to Ping An.
Oh, that I mean, I don't have any insights into that at this point.
Ping An may have more Chinese real estate exposure. That's one.
Yeah.
Because real estate, as you know, I'm not sure you guys pay attention that real estate for the last 3 months has entered a continuous decline, and it's related to the tariffs, by the way. So you can clearly see the decline happened around April. May was worse than April, and June was even worse than May. And then in a few days, we're going to get, in a couple of days, I think either today or tomorrow, we will get July numbers. We'll see. I don't think the real estate is in that good shape, especially the second tier to fifth tier cities. Anything below tier 1 city is negative growth these days. In terms of both volume and pricing. So that's probably an overhang on insurance company like Ping An because they have some investment exposure there. Xiaomi looks like share prices.
Well, they did, and they had a very good run earlier, right? When the EV model launches were made.
Yeah.
I think they had a good run. So I think it's just consolidating now.
Sure.
Yeah, I mean, I was just commenting to Johnny this morning, like Xiaomi, seems like there's nothing much recently. But I think it's just but the share price holding ground, is holding quite well. So what future catalyst is still probably more on the EV side, I think. Has to be on the sales delivery.
The sales delivery went up?
Yeah. So I'm not too worried about this name at this point.
Right now they have trouble meeting demand, right?
Yeah.
Because the production.
Yeah. I mean, you could say that maybe some of the recent negative news on the safety, on the certain features, but again, I think these are things that affect all EV makers at this point. It's still a very new technology for a lot of consumers. So the catalyst is really the product launches, the like you say, the delivery. So we still think it's going to be very strong. So
plus the international story hasn't even played out yet, right?
Yeah.
For EVs, right?
Yeah.
So when we talk about Xiaomi EV, that's predominantly sold in China.
Yeah.
Already enough
demand. I mean, if you look at my recent trip to China, it's just basically Great Wall, Guangzhou Auto, and the BYD that's there. That's these 3 brands.
Wow.
Yeah. So there's for the other EV makers, I think there's still a lot of room to grow if they're looking overseas.
Yeah, definitely. I think farming is interesting in that sense. Right now, I think you need to focus on delivering the new EVs products, and then there's also a international growth story in the wings. Um, buy the dip for BYD now. No, we're not recommending BYD at this point,
Yeah,
but we do think it's a winner of the ultimate winner, one of the ultimate winners of the EV battle, I would say.
yeah,
Yeah,
agree.
but it's too early to
Yes,
buy it.
because I think the other one that you probably have heard about the zero mileage secondhand cars. We don't really know how serious is the problem and how they'll eventually resolve that. So there's still a lot of overhang on the name now.
Sure.
Yeah.
Back to the banks again. That no recommendation on banks. Yeah, we explained this.
Yeah, because we did for the first half. I think that near-term upside is quite limited. I mean, if you're happy to hold on to the name for the dividend, fine. You can do that because I don't think there's any risk there in terms of dividend payment. But if you're looking at share price appreciation as well, then the upside is quite limited.
The upside might be better with tech. Now, let me clarify. We do have CCB as a trading buy, not a core recommendation, as a trading buy from private wealth management research. And if you follow our all the research reports, you will see in our China model portfolio, we still have CCB as one of the key positions. But that's the only bank position we have, because the story is, even though the upside may not be as great as technology, but it's a lower volatility story.
Yeah.
And the company has just done a round of capital injection. Like I said, this is good for all the big banks, except for ICBC, which will do this next year, I think. So CCB is one of the big banks that received the capital injection. The dividend yield is still attractive. In terms of price movements, maybe not. No, it's not. It's not a volatile stock. You expect to make big returns, but we keep it in the portfolio as a diversification. And I suggest, sometimes you can buy technology, but you could also have some low conviction, medium conviction names like CCB in our portfolio.
China Life again.
China Life again, yeah.
Yeah, we don't actually cover it there. We cover Ping An, AIA, we cover Prudential, PICC. But usually, from my experience, if you look at China Life, it's usually the name that outperforms at the end of the run.
Yeah.
Because usually it's if you look at the operating numbers, right?
Yeah.
Ping An is a lot more efficient, a lot better.
More commercial.
If you look at the matrix.
Of course.
Yeah. So if China Life is outperforming now, maybe people are really chasing the last, because China Life is seen more like an SOE kind of behavior.
Yeah.
And so people only buy because it's a laggard.
Yeah.
So I think it's still, that kind of argument is still valid.
Yeah.
But we don't cover it at this point.
Do you think there's also a national team now investing in Hong Kong? So is it possible that, the national team will more likely to buy China Life versus Ping An, right? Because China Life is 100% pure state-owned company.
Yeah.
So Ping An is
they could,
half and half, right?
Yeah, but I think
so there's more support, liquidity support for China Life as a state-owned company.
Yeah, I mean, we are positive on insurance now, so I think it's fine if you prefer China Life over Ping An. Yeah, but I don't have a strong view because we don't cover that name. But just saying that from experience, China Life usually runs at the end of it.
Yeah. Well, that's a laggard. I actually don't know anything about insurance, so let's just go with Mun Hon's opinion.
We talked about that earlier.
Yeah. Okay.
Okay.
That's everything here. We're at the hour. Thank you everyone for participating. The replay of the program today will be uploaded to the Wealth Vision channel on YouTube. Please make sure to subscribe to our YouTube channel for value-added contents like this. Thanks everyone. Thank you, Mun Hon.
Thank you.
Bye.